Good
Morning,
morning.
Mark.
Morning, you can hear me?
I can hear you all right. That's all loud and clear. Perfectly brilliant. Thank you.
Excellent.
So, as we usually do with these things, I'm going to get you to sort of chat a bit by yourself without me interrupting you, and then we'll put some questions later on. And if you're going to ask a question, please put that in the chat box in the YouTube, please. So Mark, can you just tell us a bit about Manchester and London and what it's trying to do then, please?
Sure. So if we put up the first slide, this shows the 9-year performance since the start of the new approach from the team at Manchester and London. You can see that the chart shows that we have created a dividend reinvested return of 16.1% for 9 years. So over the next few slides, I intend to explain the journey we took to achieve this. So if we turn to the next slide. Now, the next slide is a very standard slide on who are the fund managers. So underlined, you've got chartered accountant, CFA, degrees in economics, Russell Group universities, and having worked at Deloitte and Horgebet. So you can see that this is a very traditional set of CVs as to be expected for a fund manager. But Richard and I thought about it and thought, well, we're in a new era now. The old days of, getting an economics degree and going to the city, following that traditional route in the UK was over. And we felt that we had to understand the machine to harness the opportunities of the current era. So we went back to university to get second degrees. And it was during these second degrees in computer science that we spent most of the third year focused on studying artificial intelligence. And in addition to my degree, I undertook the first year of a master's at the University of Bath, studying specifically artificial intelligence. So if we move to the next slide. So having studied the basics of the machine, we then applied this to investment history. And we felt that the investment history of the machine or technology, whichever you would prefer to call it, in economics started with Cromford Mill, which is shown top left, created by Richard Arkwright in 1771. Now, this was a key point in history because this was the first time that a person had drawn together man, machine, and power as individual economic units in what is now known as a factory. And basically, since that date, there has been a conflict between man and machine as to who is superior at a whole range of both physical and mental tasks and functions. This is a conflict that we believe man is losing week by week. So in the timeline that is shown top right of this chart, you can see some of the other eras of technology that have defined history, including the telephone, automobile, and electrification. And you can also see the factor returns that these eras have provided over these approximate decade periods. And the returns are quite extraordinary. The bottom set of charts shows you what has happened since 1986. And you can see the investment returns created by the eras of enterprise software, e-commerce, software as a service, and social media. And just beginning on the far right, you can see AI. I would add that the bottom chart also covers a period of the dot-com. Still back. I would add that the bottom charts covers a period of the dot-com bust as well. So we have not glossed over that period. You can see again that if you'd invested in these eras, you would have made extraordinary investment returns. But I'm hoping from this slide, you can see that there is a pattern here from which we can form an algorithm for investing for the era. Step 1 of the algorithm is invest in technology. Step 2 of the algorithm is invest for the era, being the specific technology that is the revolution of the time. And step 3, identify the stocks that best represent that era. Just as a small digression, Richard Arkwright, who you could argue was the first ever technology investor, became so rich that at the beginning of the Napoleonic Wars, later in his life, the Bank of England, which was on the brink of going bust, had to come and borrow money from Richard Arkwright. It is said that the Bank of England had first approached the Church of England, but unfortunately the Church of England could not come up with the money, and therefore the quip was made that it appeared that Richard Arkwright was now actually richer than God. Anyway, so that's a good story for what happened to the first ever investor in technology. Moving to the next slide. Clearly, we now believe we are in the era of AI. And we believe that there are 4 stages of the era of AI. The first stage is a compute and data center stage. This is a build out of the AI infrastructure. This stage benefits of picks and shovels enablers such as a semiconductor and networking companies. Then comes a data and cloud computing stage where the structuring and the training of the data occurs. This stage benefits the hyperscalers and the data management companies. Next, we move to the model and application stage. Here we see the growth of the co-pilots and the agents offered to enterprise clients, and what will be coming shortly, the AI on edge applications offered to mobile customers. I think the earliest signs of success in this sub-era of stage 3 is probably the code co-pilots. And the 4th stage, we believe, will be the new unknown. So this is the stuff we never knew we needed, like Netflix and Uber in the mobile internet era. Halfway through that slide, you'll see there's a blue link. That will reference you to a newsletter, an article that I wrote, giving you a lot more detail on each of these stages, should you wish to read that. So hopefully by now, I've shown you that investing for the era is key, and it's extremely rewarding. And we are in one of the most exciting eras, potentially, of all of that past history. So if we move to the next slide. So what do we do now? How do we invest in the era of AI? Well, it's pretty difficult, actually, because paradoxically, we ourselves have repeatedly said that we actually believe that the most disruptive subsectors from AI will be software and IT. So you can't just buy a technology tracker and sort of hope for the best. The other problem, as this chart exhibits below, is that when you look at how much actual revenue companies are making specifically from AI, you can see that there are very few that are making a majority of their revenue from AI activities. Therefore, it's very hard to find the true focused AI enablers. But if we move to the next slide, ta-da! Hopefully, there we have our solution portfolio on the top left. And to the top right-hand side, you can see that we have provided some see-through financial parameters of the portfolio that hopefully exhibit that the portfolio is reasonably valued at about 19.6 times EV to EBITDA, has an exceptionally good return on invested capital at 36%, has an attractive forecast growth rate for revenues of 27%, which drops down to profits growth of 43%, with high margins of 26% and barriers to entry from an R&D to sales percentage of 17%. Hopefully, this exhibits to you that we have a portfolio with elite financial metrics. Just to sort of digress a bit on that point, we hear a lot of talk about how NVIDIA is ridiculously overvalued. I was talking to someone about this last night who was sort of talking about the UK market. And I reminded them that when ARM, which is a semiconductor company from Britain, was listing on the UK market, it used to have a valuation multiple of 32 times EV to EBITDA. And of course, when this Japanese fella called Yoda turned up and made a bid for it, he made a bid at a 50% premium to that. And yet, if you remember, everyone was coughing in their cornflakes and saying this fellow was stealing away undervalued assets from Britain. So I don't see quite how you can square the circle from ARM being on sort of 48 times EV to EBITDA to NVIDIA now being on 24 times EV to EBITDA. So I think a little bit of past history, even from the UK stock market, gives you an indication of how much more expensive these companies could become, because I would remind you that when ARM got taken out, there was no such thing as an AI bubble, as people seem to be keep calling it. Anyway, moving on this slide, I think what's also quite attractive about our fund, as you can see in the middle with that dial that shows you that our fund is not highly correlated to NASDAQ. So, should you own a NASDAQ tracker, don't worry, there's still room in your portfolio for Manchester and London. And likewise, we are not highly correlated to the other well-known technology funds in the UK market, being SMT and ATT. Our closest correlation is actually with PCT. So the next slide provides a few more sort of more micro reasons for investing in Manchester and London. The first section is structure. I do actually, and have increasingly become more convinced that structure is an underappreciated advantage for funds. Brian Lawrence, the hedge fund manager, and if you go to our Twitter feed, which is @MLCapman, I have posted a fantastic podcast with Brian Lawrence. And he's actually highlighted, when asked what's the most important thing about a fund, he has said that structure is the most important thing about a fund. So just looking a bit more at our structure, we've been listed for 50 years on the London Stock Exchange. So we are a known entity. We are closed-ended. I'm a great believer in closed-ended funds because they allow the use of sensible leverage to attempt to enhance returns. And we provide an attractive dividend yield. It's currently around 2.3%, and this is extremely rare for a tech fund. Most importantly, and what I think is very different about Manchester and London, is we have material skin in the game. So I personally have a highly committed stake in the fund. Richard has a £1.5 million stake in the fund. And Dan Wright, our chairman, has a £1 million stake in the fund. So this stakeholder approach allows us to take a long-term view on investments. And believe me, there is gold congruence here between the management team and the shareholders. We all have a North Star, which is NAV appreciation. So moving to the investment process, we focus on holdings that have high liquidity, quality, growth, reasonable valuations, and momentum. So this is key. All our holdings are profitable. This is quite rare for a technology fund. And 99% are mega large cap and liquid. And we do not have any private unlisted stuff. We are very focused on the enablers of AI. I think if you do spend some time investigating AI-focused funds, you will find that a number are focused on the beneficiaries of AI. But we do not believe that that is the route to take, and certainly not at this current point. It may become more profitable later. But we're very focused on the picks and shovels, hard technology companies that are enabling the revolution of AI. Finally, we take a pragmatic momentum-based approach, which means we do not punish winners. On the last section called people, I just wanted to highlight that we have very good segregation of duties. A number of funds have some of these functions in-house, but we have third-party and external service providers for custody, fund accounting, company secretary, and depository. We've got a few more minutes, I think. So on the next slide, I just wanted to talk very briefly, because I've noticed people always ask this question about the investment process. So we have a 6-stage investment process, and we try to use a data framework as much as we can. And we do this in an attempt to remove the human emotion element from investment decisions. So to be clear, the data framework generates for us a stock universe, and we, the humans, can only pick holdings from within that data framework universe. So, you know, you can go off and meet someone, and someone can tell you that this stock and that stock's brilliant, and they try and sell it to you. But it's simple. If it's not in the universe, it doesn't go in the portfolio. So this provides some non-human discipline to our investment approach. Now, the next slide just shows some of the financial metrics we use in this data framework. Now, please, this is non-exhaustive. There's probably about 55 to 60 different filters we use, but this slide just gives you an indication of some of the metrics that we use. And as I've exhibited earlier, the resulting portfolio has very elite financial metrics. And there is no accident that that has happened, because that is the design of the data framework. And I put a little bit of a sort of chapeau to Terry Smith and his excellent work on financial metrics and their importance in investment analysis. So moving to the last slide, we had a very good year last year. We were the second best performing investment trust in the UK with a return of 70%. And my resounding message to you is, you know, I think as exhibited on slide 3, we're in the early stages of the era of AI. I would urge you not to believe those people that tell you it's already done and over. Now, I think I've exhibited to you economic and investment history that there is most likely, or it is most probable, that we're still at the very early stages. It's going to be an extremely exciting journey. And if you're interested in investing in it, I would recommend you follow our Twitter feed, where we basically put lots of news up there about what's going on in the technology market and why we think it's interesting. So thank you very much, and I'm ready for questions.
Right, there's a few coming in now, but please do keep putting them in the chat box. So obviously these are quite volatile markets. And how do you, I mean, you already alluded to the liquidity in the portfolio, but how do you manage that sort of volatile moves in markets within the portfolio? Do you do anything about it, or do you sit tight?
Well, I think if you go to the first slide, yeah, I think that pretty much exhibits how volatile markets can be. So, I go to my GP and get a sort of weekly dose of Valium. I think that's all you can do. Look, let's be very clear, and this is why I think I talked about structure very clearly. Investing in technology over single-year periods or even 2-year periods can be a disaster, because you have to take a long-term view. Because every now and then you're going to have a down year, and then you're going to have the next year trying to get back. And if you have a really bad period like we've been through, which I just would add, it was a duration crash. So this was because interest rates went up. Interest rates are kryptonite to technology investments. So you know, the underlying stocks we had in our portfolio were still performing extremely well, but their valuations came down in line with the sort of capital asset pricing model that we all learn at university. So, you know, if you're not interested in investing on a 5-year view and a long-term view, just don't invest in technology would be my advice. As for the volatility, you know, I would say I read this excellent book the other day called Investing with Keynes. It's also on our Twitter feed. And I think he sort of deals with this. He was very keen on investing in John Maynard Keynes, very keen on investing in technology and the revolutionary stocks of the day. And he said, look, you have to understand that this is a curse to the human emotion, but actually, you know, it's a huge benefit to the stock price performance in the long term. So in other words, you know, you have to divorce the human emotion element from the machine and rational and logical element. And again, that's sort of why, you know, we built in these controls within the system of having a data framework which uses sort of logic and, you know, financial metrics so that we don't panic through human emotion.
Fair enough. But actually, allied to that, you do use gearing because it's one of the strengths of the structure. So then do you try and time that, or do you just keep that running all the time? And what sort of level of gearing now?
Yeah, that's a very good question. You know, most, if you listen to podcasts, which I do of fund managers, most fund managers will tell you that trying to time your gearing is a bit of a fool's errand. And I think it is on the whole. I think what you can do is, you know, if you're running, let's say, it's a bit like when you learn squash and you know, you're told to go to the tee point in the court, or you used to be. I haven't played it for a long time, but you know, I think what we tend to do is if we've seen a short period where the market's pulled back a bit, then we'll try to go counterflow and pick up the gearing a bit. If we've had a very good run for a while, we'll try and pull that back. And what we tend to do is we tend to really move between, with 100% is fully invested, and we tend to move between 95% and 110%. Now, you will know that the technology market and the NASDAQ market has had a bit of a pullback recently. So we moved our gearing to, I believe it was 107.8 or something like that. So as you see, we'd pushed up our gearing a bit because we'd had a bit of a pullback. In fact, you could see the sort of, well, you can't actually see it on that chart, but we'd seen a bit of a drawdown of about 10% in NASDAQ. So we do try to time it, but, you know, we really just wait for a bit of a pullback and a bit of a pause and a bit of a breather, and then we may up it.
And you mentioned the dividend, the difference the dividend makes on the chart. So one question is the dividend actually covered by the revenue that you earn, or is it paying out of capital? And the other one is, does it make sense to pay dividends rather than buy back stocks, seeing as you're on a discount?
Yeah. The first question is a good question. And again, I would refer you back to the work of Modigliani and Miller and the economic teachings of capital structure within financing of the enterprise. By which, to summarize, they said that there is no difference between a buyback and a dividend in the form of what it is and what it is doing to an enterprise. So this sort of answers both your questions. So our dividend is not covered by the dividends we receive. However, should you look on Bloomberg at the total return capital yield for our underlying portfolio, i.e. Google, for example, pays a dividend and does a buyback. If it's doing a dividend of 1% and a buyback of 1%, Bloomberg can put it together as a combined return yield of 2%, etc., etc. If you look at the combined return of our underlying portfolio, then yes, our dividend is covered. Although, you know, it requires a slightly different sort of view of more economics and financial measures rather than current general accounting practice. So that's the first question. The second question, look, you know, doing a buyback is not going to, in my opinion, and I've been on the market a long time, and I've known you a long time, James, and it's not going to close your discount in the long term. We've actually put a slide here. I've looked at this quite extensively. Discounts go in and come out correlated to the 10-year Treasury. It's on slide 13. And it's as simple as that. And I can't guarantee it, but I'll tell you this. I'd be very surprised if 10-year Treasury yields get back to, say, 2%, that all these discounts in the sector have come in. So, you know, there is a high correlation on this point. So the next point is, well, you know, when, you know, everyone then says, oh, but we're never going to have low yields again. So we're going to have to do something different. Well, you know, today the Wall Street Journal have written a big article about the accelerating depopularization of the globe. And effectively, the birth rate has now dropped below the replacement rate of 2.2 people. And effectively, there is a very high correlation in economics between the growth of the workforce and the growth of the economy. So if your workforce is going to go into decline, I'm afraid to say it's most likely that your economy is going to slow down. And if your economy slows down, we are going to see lower interest rates again. And therefore, you're going to see, most probably in the longer term, you know, funds trading on premiums again. So in other words, I think everyone's panicking about a short-term situation and undertaking permanent solutions for a temporary problem, which is not smart. So, you know, the other thing for smaller funds is, you know, buybacks adversely increase fixed cost per share and they reduce liquidity. So, you know, until someone else gets a Nobel Prize for arguing that buybacks are better than dividend distributions, then beyond Miller and Modigliani, then we'll stick with what's normal rather than what people are braying for.
Fair enough, sir. All right, okay. How do you untangle the account? I mean, obviously you're all accountants and you've done all the sort of tech stuff anyway, but are tech firms' accounts straightforward enough to actually understand what's going on within those businesses?
I've never been asked that before. Well, tech company accounts use the same, you know, general accounting policies as any other company accounts. I also would point out that I'm a chartered accountant. I trained at Deloitte. The most dangerous parts of accounts you're always taught are companies that have a long working capital cycle. I.e., you know, you get these building contractors who are building the Eurotunnel or something, and, you know, they make a profit every year until the last year, at which point they seem to make a loss for about 2 billion. And that's because that's long-term accounting. The other thing is leasing and insurance policies are extremely hard to account for. But anything that turns itself over pretty quickly is pretty easy to account for. Now, you have to remember that the second easiest company to account for is, you know, the old expression that cash is king. So if you actually look at the cash flow of a company, you know, someone like Terry Smith or, you know, Tim Steer or someone will always point you towards looking at the cash flow of a company. Well, The companies who are in technology, the large technology companies, are creating basically 75% of the cash flow of the S&P 500. So, you know, they are, you can't, you know, you can fabricate or create profits, but you can't fabricate and create cash unless you're undertaking proper fraud. I'd be very surprised if Google and Microsoft and a number of these other companies are producing fraudulent accounts.
Fair enough. Why large caps? I mean, are there no opportunities down the small cap end of the market?
Well, we do have a couple of small caps, but there's two answers to that, I think. Firstly, you know, I don't like illiquidity in stocks. I joined Horgavet and I worked at Horgavet, which at that time had a 45% market share of the UK market. And we were on the small cap team, and it was very exciting because Jim Slater told everyone that elephants don't gallop, and therefore you had to be with these sort of small caps. And oh, it's very interesting, and it was very exciting times. But every time there was a bit of a hiccup in the market, the liquidity just died. It just totally died, and you can't get out, and you get stuck. And I've never really liked that. I like we have a test here that Bloomberg tells us we could actually liquidate 99% of our portfolio in theory within 1 hour, and I like that a lot. But secondly, you know, you may have seen some of these astronomical amounts that these companies are spending on R&D. So if you turn back to this slide I showed you, yeah. And you slide 6. So R&D to sales of 17%. Now, if you've got the biggest companies in the world and they're spending 17% of their sales sticking up barriers to entry by investing that in new product development and new technology, this absolutely, it becomes very improbable that a small company is going to be able to undertake these sort of projects. Look, to put it in perspective, some of the early large language models, when they were being constructed, when they were being trained, it was costing each time they were being trained $100 million. And everyone was going, wow, $100 million just to, you know, train a model. Well, that's now moving up towards $500 million and $1 billion. So, you know, it's not the old days where you can go in your mum and dad's garage and stick something together. Do you know what I mean? It's a different. The big have a massive advantage in technology now. Just coming back to Brian Lawrence, actually, he had this rather interesting statistic where he said that going back to Richard Arkwright, actually, he was talking about that period. And he said that basically, out of the people who were considered the professional class, he'd read a statistic that there was a massive overlap in all of them, had read something like 500 books, and they were all the same books. Now, the point that I'm making now, that from that sort of knowledge, you could then maybe apply some basic engineering to form the spinning jenny. If you're going to actually now progress some of these technologies, this is not a question of a guy with a degree doing it. This is a guy who is postdoctorate doing it. He's got a PhD in this, and he's published research, and he's undertaken research. Then he's gone to a company. Then he's become the leader in a field, and he's pretty much a genius specialist in this field. To the point that, you know, if you've got a degree in this subject, you're not going to understand what this guy is talking about when he's talking about what he's doing in this area. So, you know, it's the human element here of the people who are designing these things are going to go to the very best companies. If you are, an AI electrical engineer now, you want to work for NVIDIA. If you are an AI modeling engineer, you want to work for OpenAI. You're just not going to go to a small company.
Yeah, fair enough. Nevertheless, those two holdings at the top there, they're a big, big chunk of the portfolio. So the question actually here is, how do you sleep at night?
Not very well. So I have Valium, and then I have whatever you take for sleeping at night as well. So yeah, I mean, look, it's really simple why those are those. I think there's several ways to answer this. Firstly, our competitor, because it's on this slide, Scottish Mortgage, did some work. His name slips me, but he's that fella who he's an American guy that they had on their board, who had actually gone through some of the investment eras of various technologies. That he had basically quantified that 80% of the investment returns from each of these investment eras went to just like a short handful of stocks, like 2 or 3 or 4. So in the end of the day, as I sort of stressed with these charts, ideally you probably just want the 4 that are getting 80% of the gains. But clearly, I'm not suggesting we're clever enough to do that. So point one, in theory, you only really need four stocks anyway to capture most of the game. Point two, I'd refer back to my point of John Maynard Keynes. And he had a quip that he said he was constantly pulled down for having a focused portfolio. He used to argue about just having 6 stocks. And his response was to one guy, he said, now listen, sir, I bought this stock because I believed it was elite. And now it has proved itself to be elite. I am not going to punish it for being elite. And I think that's quite a good point. So, this is why I said, look, we are pragmatic, momentum-based investors. So you get other guys, stock halves, they want to double up on it. Nah, we're not going to do that. For stock halves, we're more likely to cut it because something's going wrong. But if a stock keeps going up, it keeps churning out these elite financial metrics, it keeps proving to us that it is elite, then we're going to run with it.
Fair enough.
I have one last point on that, which is on slide. I'm just looking for it. It's in the appendix, James, and it's sort of yes. Well done. No, yes. Now so Microsoft is 26% of our portfolio. Well, I mean, anyone who thinks Microsoft is one company is crazy. I mean, look at it. So a lot of people say to me, well, I'll give you a great statistic about Microsoft. A lot of tech people who understand go, all right, yeah, I've looked at your portfolio. Where are you covering off cybersecurity? Yeah. And I say, well, I'll tell you an interesting statistic. So all the other listed cybersecurity companies in NASDAQ, if you take their R&D spend per year, you aggregate it, stack it up, it is still less than what Microsoft spend on R&D on cybersecurity every year. So my point is Microsoft is about 5 different businesses. So yeah, we've got 25% in each of them, but you can think of that as 5% in, cloud, 5% in AI Copilot, 5% in sort of applications and cyber, like LinkedIn and Xbox and gaming, and 5% in cybersecurity. So I think it's a very diversified conglomerate type company. I think Alphabet is as well. So you can sort of split out these companies. We don't have Alphabet as one of the big 2, but it illustrates the point.
When you were talking about Scottish Mortgage before and that study that they did about the big winners, the other thing of the Scottish Mortgage story is that a lot of the real winners are not going to be listed. Are there any things that you would love to invest in but you can't because they're not listed?
At this point, Not really. I mean, no, I don't think so, because as I said, we've got this finance. I mean, look, OpenAI is an extremely interesting company, but as I've said before, we're disciplined. I think, we like to buy profitable, reasonable valuation companies. James Anderson, who was a brilliant investor, you say, don't worry about the valuation. It's about what's going to happen in the future. Yeah, we get that. We totally get that. But we like to have that extra layer of sort of discipline and thinking, well, if this doesn't quite work out, is there something to fall back on here? Is there a buffer of safety? And is there proper earnings coming through? So not really, no. We don't. I personally, I personally think the most. I'll give you a very good example of that. So, XAI, which is Elon Musk's new venture, obviously his AI venture, you may have read, has been currently, and as I believe just closed its fundraise, at a pre-money valuation of 18 billion, right? And I was lucky enough to receive, on a personal level, the information memorandum asking if I wanted to invest. Manchester and London does not invest in private, so I was asked personally. I did not invest. And the reason I did not invest was because I think on slide 7, rather interestingly, he listed, no, not our slide 7.
Okay.
His slide 7. And he listed who he thought would be the great winners of the era of AI. And he put Azure, which is Microsoft, and NVIDIA. So, and he put another couple, sort of 4 or 5 companies. So I thought, I don't need to buy your company with nothing on a pre-value of 18 billion. I've already got the 2 companies as basically 50% of my portfolio that you, Elon Musk, have put in your own information memorandum.
Fair enough. Cool. Okay. Just looking at these holdings then, I just think if there's any that we'd like to dive into a bit. I suppose it would be useful to just talk about some of the ones that people don't know very well. Maybe something like Synopsys. Do you mind?
Yeah.
Tell us a bit about that.
What do I feel about it? Well, I think it's that in particular is a very good example of a company I was talking about before, where I think something I'm correct in saying that 80% of Synopsys's labor force are PhDs. So Synopsys works in the design, simulation, EDA companies, electronic design, I can't remember what the A is, automation or agent or whatever. And basically they will specialize in simulating a whole range of things for you. So in particular, Synopsys itself has a very high market share in the design and simulation of semiconductors. So if you are NVIDIA and you are going to design with software your next chip, they've just done the B series architecture chips. So they will have done that most probably on Synopsys. They may have done it on Cadence, but they probably have done it on Synopsys. And they will effectively design the microchip on this software, and they will then simulate the workings of the microchip with regard to input, output, data flows, power, and all these other elements within the software package of Synopsys. So it is an extremely interesting and niche business. And what we quite like about it is it comes back to this R&D of sales. So actually Synopsys and Cadence's revenue is paid as an output from their clients under their R&D budget. So we've often seen in history that even when you've had downturns in technology, Synopsys and Cadence have seen their revenue not be. In fact, in the last downturn, their revenues continued to go up. because the R&D to sales was sort of written in. So we rather like them because they're annuity streams. They have huge barriers to entry, and they are extremely exposed to the growth of semiconductors that we see coming with the era of AI. And I would say that they have some very interesting extra elements where every time you listen to a podcast nowadays about AI, you may have been reading about sort of digital twins. So you can get digital twins of buildings or other infrastructure or even human beings. And you can test drugs on these digital twins and see how they work. So their software and their simulation software is all leading into this. So they have a lot of opportunities for working with AI to try to push these sort of digital twins, etc., and learn more about the human body or power use within infrastructure, etc. And the last point I just want to say is, you may know, I'm reasonably interested. A lot of people sometimes say, oh, well, Mark, you bored me senseless about the era of AI. So what comes next? Well, I actually think it's the era of quantum computing. And I've been doing a course at MIT Boston on quantum computing. Actually, my second module started this week. Synopsys and Cadence are quite involved with trying to build modeling and simulation around quantum computing as well. So I think they're quite an interesting play in that way, because they're a play on the era of AI, and they could well be a play of the era of quantum computing as well.
Cool. One more before we move on. The Intuitive Surgical, because that's not a name I know either.
Yeah, basically, Intuitive Surgical were the very first people who applied automation and software to surgical machines. So if you have a hernia, James, and you go in for a standard hernia operation now, it is most likely that it will be an operation undertaken by a surgeon and one of their Da Vinci machines. So if you search Da Vinci surgical machine, in fact, they've got some fantastic videos on their website, and it'll show you this machine cutting you open and, stapling together your hernia and inner linings and all that business, and then sewing you up and then putting it all together. So this is more of a story of automation of the machine going forward. But the error rate of simple minor surgery procedures is radically reduced by these machines. Obviously, they can work all day and all night, and Intuitive Surgical were the first guys to do it. They have an installed base of multiple thousands of these machines, particularly across the USA, but even across China and other places. And it's a very much a sort of, some analysts may talk to you about an installed base stock. So, once they've got their installed base there, then you have to get your machine serviced and you have to get parts for it. But it's an extremely interesting stock, and I strongly suggest anyone going to their website and watching some of their videos, because you could easily see in the future, every day you pick up the newspaper and it says we can't get NHS surgeons and all these sort of people to come, and there's all these visa problems and blah blah blah. Well, the solution is here. Get the machine to do it.
Good. Thank you very much indeed for this morning. That's really interesting. A lot of favourable comments as we've been talking. So we'll get you back on again another time, I think, and see how it's been going, but maybe a year or so, and get up with it in the meantime.
Thank you very much.
Thank you. Next week, slight change of pace. We'll be talking about vehicle infrastructure. And then, as I say, we've got a full lineup of things going forward for you. So have a great weekend, and I will back to talk to you next Friday. Bye-bye.